Mixed economic news this week, which makes the call on the next cash rate move more complex. But even at current levels, more households are getting crunched as wages fall, debts rise, and property prices turn. Welcome to the Property Imperative Weekly to the 7th of October 2017. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics, with the latest digest of finance and property news. The big shock this week was the horrible retail spending data from the ABS. Retail turnover in August declined for a second month, down 0.6%, the worst monthly performance in more than 4 years, which puts economic growth at risk. In seasonally adjusted terms, there were falls in all states and territories, but Victoria fell 0.8% and Queensland 0.8%. The full impact of the August slump will be seen when the September quarter GDP figures are released. Last time, the share of economic growth flowing to wage earners fell to 51.3% in trend terms, and that's the lowest since 1964. Commonwealth Bank economist Gareth Aird said that mortgage interest payments are taking up a larger proportion of household income and were acting as a handbrake on consumer spending and the retail sector in general. All too true, as followers of our blog will know, poor wage growth is the problem. Even the Prime Minister highlighted the impact of slow or no wage growth. While we're seeing strong growth in employment, we're yet to see strong growth in wages, so people feel as though they're not getting ahead, Mr Turnbull told Neil Mitchell on 3AW radio. But it's more than a feeling, it's an economic reality. To underscore the pressure on households, we released our mortgage stress data to the end of September, which confirmed the uptrend by crossing the 900,000 household Rubicon for the first time. We found that across the nation, more than 905,000 households are now in mortgage stress, up from 860,000 last month, and more than 18,000 of these are in severe stress. This equates to 28.9% of households. A rising number of more affluent households are being impacted as the contagion of mortgage stress continues to spread beyond the traditional mortgage belts. We estimate that more than 49,000 households risk default in the next 12 months, which is 3,000 up from last month. You can watch our video summary to see which postcodes are most impacted. New research commissioned by mortgage brokers iSelect through Galaxy Research, which polled more than 1,000 Australians, also found that 25% were experiencing difficulty covering their mortgage repayments, and 33% had had their interest rates increased in the past year. Almost 40% of households making their payments have no surplus left over, and if interest rates were to rise by 1%, they say more than 780,000 mortgage holders would struggle to make repayments. This includes 632,000 households which would have to cut back to cover repayments, and 150,000 who will be forced further into debt. Roy Morgan Research mortgage stress data also confirmed the rising pressure, with a rise to 17.3% despite a decline in loan rates. Those they identified as extremely at risk also increased from 12.4% to 12.8%. Now they define stress on a different basis to the DFA cash flow method, but the trend is still clear. We also found in joint research with Hashching a massive discrepancy in home loan interest rates across New South Wales, with vast differences in rates even within the same suburbs. The data shows that in some cases, neighbours are paying up to $87,000 more for new owner-occupied loans, 105 basis points disparity, and more than $200,000 for refinanced owner-occupied loans at 235 basis points disparity. The calculation is based on an average home loan of $500,000 over 25 years. Those borrowers paying higher rates are essentially adding an extra 3 years of mortgage repayments to their loan. More bad news from banking analysts at UBS, who said a third of borrowers with interest-only loans do not know or understand that they've taken out an interest-only mortgage. According to the results, 23.9% by value of respondents stated that they were on an interest-only mortgage, which is well below APRA's figure of 35.3%. UBS said, while we initially suspected that this was a sampling error, we believe a more plausible explanation is that around 1/3 of interest-only customers do not know or understand that they have taken out an interest-only mortgage. We are concerned that it is likely that the approximately 1/3 of borrowers who have taken out an interest-only mortgage have little understanding of the product, or their repayments will jump by between 30 or 60% at the end of the interest-only period. Now, whilst FBAA Executive Director Peter White said that the conclusion was, to quote, the biggest load of nonsense on the planet, unquote, and that there was no analytical data to support what they were saying, DFA analysis shows that over the next few years, a considerable number of interest-only loans due for review will fail current underwriting standards. So households will be forced to switch to more expensive principal and interest loans, assuming that they can find a lender, or maybe even forced to sell. Now, the same drama played out in the UK a couple of years ago when they brought in tighter restrictions on interest-only loans. We conservatively estimate around 7 billion will fall due this year, 9 billion in 2018, and rise to 20 billion in 2020. So the value of the loans is significant, and if UBS is right, may be understated. The IMF released their Global Financial Stability Report, and Australia got a mention for all the wrong reasons. With household debt now 100% of GDP, we are at the top end of the risk curve. Whilst increased household debt gives an economy a boost in the short term, the IMF has found it creates greater risks 3 to 5 years later, lifting the potential for a financial crisis as households struggle to repay. Given the ultra-high debt levels in Australia, this is an important observation, and we're entering the danger zone now. Data from the RBA showed that overall household debt rose again, with the household debt ratio now at a new record of 193.7. They left the cash rate unchanged for the 14th consecutive month. But the real problem is that with the current economic settings, mortgage debt is growing at more than 3 times income or CPI. There can be no excuse for this, and the settings need to be changed now. Even the property news was mixed. ABS data showed overall building approvals were up 0.4% in August, but had fallen 1.2% on revised figures in July. This was driven by apartment approvals, which was up 4.8%, while approvals for houses fell 0.6%. Year on year, the news is still bleak. Approvals were down 15.5% on that basis, the 12th consecutive month they have fallen. The HIA home sales data for August lifted, but whilst the increase in sales offset larger declines in sales in recent months, it was not sufficient to reverse the decline in sales that is evident since early 2016. The auction volumes were down last week, thanks to the grand finals and long weekend, but clearance rates in Melbourne remained firm. And CoreLogic's September home price series showed slippage in Sydney, down 0.1% in the month, although the national average was up just 0.2%, with Hobart and Melbourne leading the way. The bottom line is this: we're certainly at a tipping point, and more evidence is amassing of the risks to households, to the housing sector, and to the broader economic outlook. Worryingly, we think there are strong echoes of the pre-GFC conditions which existed in the USA. High debt, extended home prices, suspect mortgage underwriting standards, and the risks of rates rising. There is now a very limited window for regulators to get their act together and head off the potential crash at the pass. The problem is, intervention also risks creating the crisis they're trying to prevent, so regulators are in a bind, and politicians would prefer to kick the can down the road. The signs are there for those who want to see them, but many prefer to look away. And that's the Property Imperative Weekly to the 7th of October 2017. If you found this useful, do leave a comment below, subscribe to receive future updates, and check back again next week. Many thanks for watching.